Hello, everyone. My name is Elena. Today, I work as a corporate executive. But years ago, I was a college freshman trying to figure out how to pay for school. And one of the most important financial decisions of my life happened before I attended a single class. It happened when I opened my financial aid package. I remember feeling excited. I had been accepted to college. Everything seemed to be falling into place. Then I looked at the numbers: tuition, housing, books, fees, living expenses. The total was much larger than I expected. For the first time, I realized that earning a degree was not only an academic decision, it was also a financial decision. Like many students, I started thinking about student loans. At 18 years old, borrowing money sounded simple. Take the loans, graduate, get a job, pay them back. What I didn't fully understand was that every dollar borrowed creates a future obligation. Student loans can help create opportunities, but they also create responsibilities. And those responsibilities can last for many years after graduation. That's why the most important question isn't, can I borrow the money? The more important question is borrowing the money worth it? That question changed the way I thought about college. Because education is often an investment. Like any investment, it has costs, and it has potential benefits. The goal is to make sure the benefits justify the costs. In this video, I'll share the lessons I learned about student loans, borrowing, interest, repayment, and making smart financial decisions. And we'll begin with the foundation of every borrowing decision. How do you determine whether a college education is worth the debt? When I was preparing for college, I thought about education very differently than I do today. Back then, I saw college as an expense, but after years in the workforce, I learned that education should be evaluated as an investment. And every investment deserves a simple question: what am I getting in return? The cost side is usually easy to see: tuition, books, housing, student loans. The benefit side is less obvious. Benefits often show up years later. A degree may help you qualify for better jobs. It may increase your earning potential. It may provide greater job security. And it may open doors that would otherwise remain closed. That doesn't mean every educational choice produces the same return. Different careers often lead to very different income levels. Different programs have different costs, and different students have different goals. That's why borrowing decisions should never be made blindly. One guideline I wish I had known earlier is this: try not to borrow more than your expected first-year salary. If a career is expected to pay about $50,000 per year after graduation, taking on $40,000 in student loans may be manageable. Taking on $100,000 might be much more difficult. But money isn't the entire story. Education can also provide personal growth, professional networks, skills, confidence, and opportunities that cannot always be measured in dollars. The key is finding balance, understanding both the costs and the benefits. Because the smartest borrowers don't just ask, how much can I borrow? They ask, what kind of return am I likely to receive? And that question became even more important when I started filling out the paperwork that would determine how I paid for college. That's when I discovered FAFSA and the different types of student aid available to students. After deciding that college was worth the investment, my next challenge was figuring out how to pay for it. That's when I completed the FAFSA, the free application for federal student aid. At the time, it felt like just another form, but it turned out to be one of the most important financial documents I would complete as a student. A few weeks later, my financial aid package arrived. Inside were several different types of aid. Some money I wouldn't have to repay, and some money I would. I quickly learned that grants and scholarships are very different from loans. Grants and scholarships are essentially free money for education. Loans must be repaid later, often with interest. I also discovered that not all federal student loans are the same. Some were subsidized, others were unsubsidized. At first, those terms meant nothing to me, but they matter a lot. With subsidized loans, the government pays the interest while you're in school. With unsubsidized loans, interest begins accumulating much sooner. Looking back, I wish I had paid closer attention to those differences. Because understanding your aid package is just as important as receiving it. The more you understand today, the fewer surprises you'll face later. But my financial aid package still didn't cover all my expenses. And that's when I faced another important decision. Should I borrow from federal loans or look at private student loans as well? My financial aid package helped a lot, but it didn't cover everything. I still had expenses that needed to be paid, so I started looking at additional borrowing options. That's when I discovered there were two major types of student loans: federal loans and private loans. At first, they sounded very similar. Both provided money for school. Both had to be repaid. Both charged interest. But the more I learned, the more I realized they were very different. Federal loans are provided through the government. They typically offer fixed interest rates, flexible repayment options, and protections for borrowers who experience financial hardship. Private loans are offered by banks, credit unions, and other lenders. They often require a credit check. Many students need a cosigner, and repayment options are usually more limited. One lesson I learned is that federal loans are usually the first place students should look when borrowing for education. Not because borrowing is always good, but because federal loans generally provide more flexibility if life doesn't go exactly as planned. Careers take time to develop. Job searches can take longer than expected. Unexpected challenges happen. Those protections can become very valuable. Looking back, I'm glad I took the time to understand the differences before signing anything, because choosing the right loan can affect your finances for many years. But there was something even more important that I didn't fully understand at the time: interest, and what happens when it quietly accumulates while you're focused on classes, exams, and graduation. A few years later, I learned a lesson that many students don't fully appreciate when they first borrow money. Interest never takes a vacation. While I was attending classes, studying for exams, and planning for graduation, interest was quietly accumulating in the background. At first, I barely noticed it. After all, I wasn't making monthly payments yet. But when I checked my loan balances more carefully, I was surprised. Some balances were larger than the amounts I originally borrowed. That's when I truly understood the difference between subsidized and unsubsidized loans. With subsidized loans, interest generally does not accumulate while you're in school. With unsubsidized loans, interest begins building much earlier. And if that interest isn't paid, it can eventually be added to the loan balance. This process is called capitalization. Once that happens, future interest is charged on a larger amount. Interest can start generating even more interest. The result is a higher total repayment cost. Looking back, I wish I had understood this sooner, because even small payments toward interest while in school can reduce future costs. The lesson was simple: the amount you borrow matters, but understanding how interest works matters just as much. So, I began looking for ways to reduce how much I needed to borrow in the first place. After learning how interest could increase the cost of my loans, I became much more careful about borrowing. Instead of asking, "How much can I borrow?" I started asking, "How much can I avoid borrowing?" That change in thinking saved me a lot of money. First, I started searching for scholarships more aggressively. Even small scholarships helped reduce the amount I needed to borrow. Second, I looked for opportunities to earn income while in school. A part-time job didn't make me rich, but every dollar I earned was one less dollar I needed to finance with debt. I also became much more intentional about my spending. I created a budget. I paid attention to where my money was going, and I tried to separate needs from wants. Some choices were simple: cooking more meals, buying used textbooks, taking advantage of student discounts. None of these decisions felt dramatic at the time, but together they reduced my expenses significantly. I also learned an important lesson about loan offers. Just because you're approved for a certain amount doesn't mean you should borrow the full amount. Every borrowed dollar eventually has to be repaid, usually with interest. Looking back, the smartest strategy wasn't finding more loans. It was finding ways to need fewer loans. And by the time graduation approached, I was very grateful for every dollar of debt I had managed to avoid, because soon it would be time to start paying those loans back. Graduation day finally arrived. I was excited, relieved, and ready to begin the next chapter of my life. But there was something waiting just beyond graduation: my student loan payments. Fortunately, federal loans typically provide a grace period after graduation. That gave me time to settle into my career before payments began. Still, I knew repayment was coming, so I started reviewing my options. I learned that there isn't just one repayment plan. Some borrowers choose a standard repayment plan with fixed payments over 10 years. Others choose plans that start with lower payments and increase over time. There are also income-driven repayment plans that adjust payments based on income. Each option has advantages and disadvantages. Lower monthly payments may provide short-term flexibility, but they can also increase the total interest paid over time. Higher monthly payments can be challenging initially, but they often reduce the overall cost of the loan. As I evaluated my choices, I focused on one important goal: keeping my student loan payments manageable within my budget. I wanted enough room to save, invest, handle emergencies, and build a stable financial future. Looking back, repayment wasn't just about sending money to a lender. It was about creating a financial plan that allowed me to move forward with confidence. And that brings me to the most important lessons I learned from my entire student loan journey. Looking back, there are 5 lessons I wish someone had taught me before I ever signed my first student loan document. First, borrow thoughtfully. Just because you are offered a loan doesn't mean you should accept the entire amount. Every dollar borrowed is a dollar that must eventually be repaid, usually with interest. Second, understand how interest works. Interest can quietly increase the cost of borrowing over time. The earlier you understand it, the better financial decisions you'll make. Third, use federal loans before private loans whenever possible. Federal loans often provide more borrower protections and greater repayment flexibility. Fourth, look for ways to reduce debt before you borrow. Apply for scholarships, apply for grants, work part-time if possible, and live within your means. Every dollar you don't borrow today is a dollar you won't have to repay tomorrow. And fifth, think about the return on your educational investment. Consider the cost of your education. Consider your expected career opportunities, and consider how your future income will support your repayment obligations. When I was 18, I thought student loans were simply part of going to college. Today, I understand they are financial decisions that deserve careful planning. The good news is that student loans are not inherently good or bad. They are simply financial tools. When used wisely, they can help create opportunities that might otherwise be unavailable. My education helped me develop valuable skills, build a successful career, and create opportunities that continue to benefit me today. But those benefits came from making informed decisions along the way. So as you think about your own educational journey, remember this: the goal is not simply to earn a degree. The goal is to build a future filled with opportunities, financial stability, and choices. Thank you for spending this time with me. I'm Elena, and I'll see you in the next video.